Good morning, everyone. Marty Mazzora here. It's the 7th of November, 2025, with a quick market update for you. This would be the end of the week update. I got to keep it quick as my schedule demands this morning. So I'm going to jump right into it. I'm going to touch briefly on some charts and go to my notes and just kind of speak to what we've been seeing of late. So the first one that you have in front of you here is the sector leadership chart, is what we call it. And I showed you this the other day, and it was a short-term chart that showed that the S&P was up, but over half of the major sectors were actually down. So it was tech that was really moving the market, as it has been for quite some time. This last week, and this is Monday back here, and here we are just starting Friday, it's been more or less a flip of that sentiment, although not much is up, as you can see up here with these lines above the zero dotted line here. What's up a little bit this week are financials, up 0.2%. You can see industrials are down almost 2%. Materials are down 1/3%. Tech down 5% this week. Consumer discretionary down 2%. Energy up 1.5%. Healthcare up 0.5%. Consumer staples up 2/3%. Utilities down 2/3%. REITs, real estate, up 0.4%. Telecom down 2.3%. So our core portfolio has captured about half of this week's decline. The S&P, at least through yesterday, was down 1.75% on the week. Our core portfolio is down like 0.85% on the week. That was through yesterday. And so part of that is because we've been adding a bit to our energy exposure. We've added recently to healthcare. A good sized sector weighting in the U.S. for us is consumer staples. We're certainly underweight tech relative to the rest of the world for all the reasons I've been talking about here on the blog. And you can see here with this morning's move, the S&P is actually down 2.2%. Just for context for you clients, as I speak, the S&P is down just over 0.5%, 56 basis points, 0.56%. Our core allocation is down 14 basis points, just 0.14%. So again, capturing less of the downside. And for most of the year, we've actually captured more of the upside, but it's not so much because we're in U.S. stocks. It's because of allocation to other regions and then commodities. I talked a lot about our position in gold this year and so on. So yeah, we feel like we're taking less risk and we're having a good year relative to the risk we're taking. But folks, we are taking absolutely zero for granted. This is as challenging a market as I've had to navigate in my 41 years, I assure you. And so I created a chart this morning that shows us the major hyperscalers we've been talking a lot about. This is just this week so far. Meta in white, down 6%. Google in blue, down 0.8%. Microsoft down 4%. NVIDIA down nearly 10% this week. And again, here's the S&P when you count this morning, down 2.3% so far this week. So, Meta in particular is interesting because it has gotten absolutely creamed over the last month. And it happened pretty much on one day, which is when it announced earnings on October 29th. And the earnings were actually good, but folks, to the point I've been making, they announced massive capital expenditures next year. And remember, I've shown you the data that the companies that are spending bigly on CapEx tend to underperform going forward the companies in the same space that do not. And you can see the market really reacting to that. Not so much with the other ones. You can see Google, which is fascinating to me, that Google is holding up really, really well. So their numbers have been good. But you think about Google's challenges with what AI does to search and how the revenue comes from ads on search. So they are spending billions to stay in the game or stay ahead of the game. Monster question is, are they really going to be able to capture enough revenue, particularly Google in my mind, to justify all that spending? And the market is beginning to sound a concerning tune with regard to that. We hit that pretty hard last week. And this week we've been hearing from major Wall Street firms that, a 10 to 20% correction is coming within the next year or two. That is a my view, is a very benign statement to make. 10% corrections happen once a year. But that was a big alarm that just kind of freaked the market out a little bit this week. And they're tying a lot of that to this massive spending on AI and questioning whether or not it's really going to provide the ultimate earnings for these companies to justify what they're spending. So that's something that obviously we'll be talking about for quite some time. It's not letting up anytime soon. There's no reason to think this bubble bursts tomorrow. There is a reason to think this bubble does burst, and the manner of that bursting, of course, remains to be seen, but we'll continue to keep you abreast of the details and what we're thinking about them going forward. Keep in mind, folks, that it is the best seasonality of the year is almost upon us, particularly post-Thanksgiving. I do see a number of catalysts that could help that out. Number one, this correction that we're having this week is positive if you're looking for that big year end and then that Santa Claus rally at the very end of the year. Because you're coming off of lower levels, you're getting some of this sentiment kind of washed out of the market all of a sudden. Advisor sentiment was still too high this week, but overall sentiment is really fallen. In fact, if you look at the city's sentiment gauge, it's extreme fear, and that's typically positive from a go-forward outlook for stocks. Now people are starting to load up on the bear side of the boat, and you get a little bullish catalyst. It could be a great announcement with trade with China or other countries. Could be a reopening of the government, which has to be coming relatively soon, and a number of other geopolitical things that could be, if not remedied, you could get some positive rhetoric that might make the market feel a little better about itself right here. Another problem this week has been the Fed and their commentary that is still pretty hawkish. That many of the Fed governors, if not the majority of the speakers this week, are sounding the alarm that inflation is a big concern of theirs right now, perhaps more so than what I'm going to show you in a minute, and that is weakening employment data under the surface. Part of the problem is the data that comes out of government agencies, which is probably the majority of the data that people on the Fed and people like us look at, isn't available because the government shut down. So it's going to be interesting to see when it reopens and what we get for that. And since I'm on the charts, might as well go ahead and do the S&P. The daily chart shows us breaking down yesterday below this trend line right here. That is a sell signal. And we're following through today and testing the 50-day moving average. If it breaks that with force and with momentum, technically speaking, all else equal, that's very bearish, and you could see the market move lower. We still have these long bearish divergences. We now have a sell signal on the moving average convergence divergence. We are coming way off of overbought territory. In fact, by some measures, the market is already pretty oversold, not yet by the RSI. And again, that's a place you want to be if you're hoping for a year-end rally in stocks. More concerning, though, are the longer-term charts, and I'll just jump to the 30-year monthly chart. And I've done this with you before. Same thing with gold. It's so overbought right now. But this red area right here on the relative strength index is technically overbought territory above 70. And you can see it doesn't happen all that often. This is a 30-year chart. When it happened here, we got a 50% hit to the market. We got a 60% hit nearly right here off of overbought territory. Right in here, it was only 16%. In 2018, it was 10% and 20% respectively. Two moves off of overbought territory. This was nearly 30% in 2022. And you can see this one right here came down with a 21% decline earlier this year. And we're right back into overbought territory. So it would make sense that sometime over the next few weeks or months that we see something to the downside in double-digit proportion. And again, this is just purely technically speaking. I just mentioned a few things that could bring some oomph into the market right about now that I think the market would welcome. Another few days or week or so of this kind of downward draft, again, sets even a bigger stage and gives the powers that be the incentive to talk the market back to life. With regard to the Fed, it's going to be very interesting. Despite the somewhat hawkish talk this week, as of yesterday, Fed funds futures priced in a little better than a 70% chance of a rate cut in December. So the market is still counting on a rate cut. Typically, the Fed does not go against those predictions, we'll call it, in the Fed funds futures. So basically, they do not want to shock the market. So between now and December, if they really don't want to cut interest rates, they're going to start sounding much more hawkish and get those odds much lower. If that doesn't happen, you can pretty much count on it. But it's really going to be the sentiment. It's going to be the press conference. It's going to be what Powell intimates about how they're feeling about things going forward. When they got the rate cut here a week or so ago, mortgage rates went up 0.25%. So I think that probably spooked them a little bit as well. They don't want a repeat of last September where they cut 50 basis points and then 2 more cuts of 25 by the end of the year, and mortgage rates went up 1 full percentage point. That's probably on their mind right now and has something to do with why they're kind of walking back the prospects for a December rate cut. But to kind of counter that thinking, let's take a look at our recent notes. And I'll just start at the top, and I'll get down to what I'm talking about right here. So again, emphasizing the point that the market punishes spending even when it's on CapEx and R&D. DoorDash here this week dropped 14%, one of the sharpest drops that day, when they warned investors, keyword warned, that they're going to be spending significantly on product development next year. I told you the other day, for years I've had clients and friends, you say, hey, they're going to be spending a lot of money. Maybe we should buy the stock, and it's exactly the opposite. As I showed you on the last video, what those longer-term statistics about stock performance and CapEx spending suggest. So Bespoke Investment Group, we pay for their research as well, actually are showing us that the earnings outlooks have actually been unusually good even this week, despite the fact that the market's been trading lower. So that's an interesting dynamic as well. So this is from BCA's morning call the other day, and I thought this was interesting. So they call it How to Drive Through the fog being the government shutdown. So what other data can we look at to get a feel for what's going on, for example, in the job space? So the Chicago Fed has a model implied unemployment rate. So they have a model, they look at trends, and they look at what is likely to happen with unemployment going forward, and their model says it's likely to continue going higher. Okay, and that sort of data, or if there's data that supports that, that's the sort of thing that would make the Fed feel good about a rate cut, say, as early as this December. And then job openings, of course, from Indeed and LinkUp. They are not government agencies, so we're getting their data, and you can see consistently that has been dropping, and nothing seems to be letting up there as well. So here's an interesting chart. You can see this unprecedented gap between the S&P 500 and U.S. job openings. So the gray line is the S&P all the way back to the year 2000. There's the great financial crisis. There's COVID, right? So there's the S&P, all-time records. And look what seems to be happening to job openings. And okay, you can talk about the COVID effect. You can talk about a lot of things, the overhiring and so on. But we do have to talk about the fact that this chart is showing a historic divergence, right, in terms of what this suggests about the economic or the corporate state of affairs and how the market just keeps melting up anyway. Folks, that billions upon billions upon billions in AI spending has a lot to do with that. So this makes longer term, mid to longer term, for I think a pretty precarious setup, despite the fact that I would not be surprised to see quite the nice year-end rally this year. Could be wrong, doesn't have to happen. Last time it didn't happen was 2018. This one just caught my attention. This is from BCA as well. Korean and Taiwanese purchases of U.S. stocks. Now, we've talked about the fact that something like 70 cents of every dollar that's come into the U.S. market the last few years has come from a foreign investor. Well, look at the chart of Korean investors and Taiwanese investors going into U.S. equities. And this is a global phenomenon, folks. The Norwegian Sovereign Wealth Fund, which is the largest sovereign wealth fund on the planet, like 9 of the top 10 holdings are the big U.S. tech stocks. I think the one that's not is in Taiwan Semiconductor. So really, really bold up there. Now, if we get somewhat of a break, if we get somewhat of a correction, and these investors get spooked and begin to dump those very profitable positions, and again, this is not just a Korea and Taiwan phenomenon, that could create quite the snowball effect as people think through the fact that they made so much money, and now they're hearing from folks like us, and hey, maybe this AI spending craze is indeed a craze right now and needs to take a breather. Now, the bullish side of that scenario for us is that if we did get a big global sell-off of these big U.S. tech stocks, that would be net all things equal, that would lead to a weaker dollar as people sell dollar-denominated equities and move back to their respective currencies. So you'd see a repatriation perhaps, and that, again, all other things equal, would be net bearish for the dollar. And our portfolio overall is net short the dollar, so we tend to do better in a weaker dollar environment, which is our longer term thesis, which we've talked about and we'll talk about more as we go. Lastly, this is from an interview with the CEO of FreightWaves. The interviewer asked, should we be worried? He said, well, we should be. The goods economy, certain portions of the goods economy are collapsing right now. Year-over-year trucking volumes, this is really a predominance of freight that moves across the U.S. is down 17%. But when you look at the industrial sectors or the freight that moves over the long haul, this is energy, automotive, housing, and manufacturing. We're down 30% year over year, which is very great financial crisis levels of concern. Statements like great financial crisis levels of concern, folks, despite the fact that we've got issues in the private credit space, which I have talked about, which are of concern, they're not to the point that would resemble a 2008 scenario. Now, I've said that, it makes me a little nervous when you hear them poo-poo the subprime auto space problems, the recent bankruptcies. Sounds like Ben Bernanke poo-pooing the subprime mortgage situation back in the day. It is different this time. Bank balance sheets are uber healthy as we speak. Now, under the surface, they do have exposure to these or in these private credit scenarios. But this does not look like something that would blow up all over markets and all over the economy. These things are not marked to market like mortgage-backed securities were. I do think it's net negative. Of course it is. To what extent, we do not know, but we have to watch it evolve. But it's more likely to be something that's a slower type scenario, and you feel it weigh on the economy, and as it gets more prevalent, we see where the risks and the cracks open up. But again, notably different overall than the mortgage-backed securities scenario back in 2006, 2007. So folks, just in a nutshell, clients, we are continuing to hedge the positions that we think are out over their skis. We've cut exposure in the commodities space. We have added some exposure in a sense that would take advantage at the margin of a nice year-end rally if it comes, but not enough to be overly detrimental if it doesn't come. Thank you very much for watching and listening as always. Hope you all have a great weekend, and I will talk to you again next week. Take care. Bye-bye.